A very good morning to all of you. I am Akanksha Rawat, Academic Officer at Institute of Company Secretaries of India. I welcome you all to this webcast on Financial Treasury and Forex Management. We have with us today Professor Dr. Alok Pandey. He is Professor in Finance and Member Secretary of Academic Advisory Board, Lal Bahadur Shastri Institute of Management. Sir, we welcome you for this webcast on FTFM. I hope our students will gain a lot from this session. All the students who are viewing this webcast can ask their query related to the subject, which we will try to take up in the second half of this session. I now hand over the session to Dr. Pandey, who will briefly explain you the basics of corporate finance. Then we will touch some topics from security analysis and portfolio management and financial derivatives. Over to you, sir.
Thank you, Akanksha, and I thank the Institute of Company Secretary of India for giving me this opportunity to interact with the students of the institute all across the country. So we have several topics as part of your course on financial treasury, financial management, financial treasury and forex management. Now, as we go ahead, we'll have 3 hours with you, and we'll start looking into several aspects of corporate finance. Then what we have called security analysis and portfolio management as one of your topics. And then we'll move on to derivatives, introduction to derivatives and forex management. I'll give you a brief idea. I hope you are aware of the basic ideas of capital budgeting, cost of capital and capital structure. In these, cost of capital is the topic which you must be aware of, because that has impact on almost all topics which we discuss here. If you look at cost of capital as a concept, the cost of capital is about how a company raises finance and at what cost. And cost of capital again is defined in terms of weighted average cost of capital, and weighted average cost of capital is nothing but about the capital structure. So suppose a company has taken loan, that is debt, and also has some equity in a ratio of 60:40. So we say there is a 60% weight of loan and 40% weight of equity. We take after tax cost of debt and then add the equity cost, multiplying it by the weight equity. The formula basically works out as W multiplied by debt, that is weight of debt into the cost of debt multiplied by 1 minus T, plus weight of weight in equity and the cost of equity. So when we have cost of capital as a concept, we must really understand as to why and how do we use it. So when we take cost of capital as a concept, it has several uses. One part of the cost of capital is that we work on a particular concept that if we have to rate a project, whether we have to invest in that project or not, whether we have to select a particular project or not, that is one part of it. The second part of it is that how do we calculate the cost of capital itself if there are several components in the cost of capital itself. This also is linked with our topic on security analysis and portfolio management, because some of the methods by which you calculate your cost of capital, they basically are about using a particular model in security analysis, which is called capital asset pricing model. We also use the bond valuation methodologies here to calculate the cost of debt and otherwise. So when it comes to our understanding of cost of capital, very quickly I'll tell you that what the concept is and how it really works. If you look at it carefully, every company which is in existence needs funds to survive. So the option for running a company which is an entity supported by the money from shareholders who are common equity holders is that regularly it needs funds for its day-to-day affairs, for long-term capital investments, for serving the customers. Say for example a cement factory. When there is a growth in an economy, cement becomes one of the key elements, and this particular element is used in infrastructure development. Now companies, when they have to establish a cement factory to cater to demand, for example suppose there is a company called ICSI, Associated Cements Limited, and now it has suddenly expected that in the next 5 years, the government of India will enter into a spree of projects, a string of projects on infrastructure, say roads, other buildings, bridges, etc. And a lot of demand for cement will happen. For that, they'll need to establish a cement plant. Now, what do they need to do? Of course, what they'll do is they'll do a special capital budgeting exercise for this particular project, if it's an additional project in the hand of the company. While evaluating the project, you know that they will evaluate the cash inflows into the project, cash outflows. Say cash inflows means from the project, money which you receive. Cash outflow means amount of money which the company will invest in the project. Now, this amount of money which the company will invest in the project will have to be either borrowed, or the company will have to go for a fresh equity offer. Now, this is what brings the concept of cost of capital into the picture. So, when we have, suppose the company goes ahead and borrows from the market, say from the bond market. So, it will largely look at the yield idea for cost of capital. Suppose the company has something called the equity, then we value equity, right? Now, as you go ahead and look into these concepts, the company will have to be very careful from where is it borrowing the money, from whom it is borrowing the money, what are the risks involved in borrowing the money, and all of them together will form something called the cost of capital of the project. Now, suppose the company borrows say 100 crore rupees from the market, and another 100 crore rupees comes from the shareholders. So, 200 crore rupees have been collected for this. Suppose the cost of equity is 10% and cost of debt, for example, again is 10%. So, what you will do, you will calculate something called weighted average cost of capital. If the average tax rate is 30%, you will multiply your weight of debt. I'll first tell you the calculation without the tax, and you can always calculate the tax, as you know, you are a finance student. So, if I ignore tax, for example, then I'll say 100 crore rupees have been 50% of funds at 10% and 50% of funds at 10%. So, the overall cost of funds will turn out to be 0.5 into 10% and 0.5 into 10%. You change the ratio and the cost of capital will change. Say one is 60%, one is 40%, and what you will calculate is something called a weighted average cost of capital, which becomes a basic idea for calculating and evaluating a project. Now, when you evaluate a project, of course, you will utilize this cost of capital concept for calculating the IRR. You know, if suppose you calculate the IRR of project, you will calculate which one is higher and which one is low. If the IRR of the project is higher than cost of capital, the project is selected. Similarly, cost of capital is the rate of reinvestment in the NPV methodology. In NPV, you select a project when the project has a positive net present value. That means it generates wealth for the, if it is negative, and it will be positive only when the returns you get on the project actually are more than the cost of capital. So, these things actually make cost of capital a very, very important idea to understand. Now, when you look at cost of capital as a concept, you must understand that this is used as a hurdle rate. This is used as a method for identifying whether to invest in a particular project or not. This is a kind of a yardstick used by companies, and I'll not get into formulas right away, but yes, what you need to understand is that calculation of cost of capital has broadly one part technique. So, the technique part basically, like if for example it's debt, so debt, you find out, you know, the IRR of the debt actually becomes the cost of debt, whereas for equity you can use the CAPM model of equity or other models of equity for calculating the cost of capital. So, first thing is you collect information. For example, if I have to take a loan, I'll go and compare what is the yield on the government bonds today and what premium I pay on the above the present rates, so as to get what you call returns, or this will become the cost of debt. In case of you can also go and check up with banks as to what is their lending rate. As you know that nowadays banks normally calculate marginal cost of lending rate, as to what is the lending rate applicable today and what best possible rate can you get. So, that also is one of the cost of debt. The rates at which the companies have raised their debt, that is bond yields in cement sector and so on. So apart from this, when you look at what you call the equity part, in equity the methodology is slightly different. If you look at the equity part, when you calculate equity cost of debt, there are two broad methods. One is something called the discounted cash flow method, and the second is called capital asset pricing model. Now this is where cost of capital is linked to your security analysis and portfolio management as well. So when you say cost of capital or cost of equity, the cost of equity often is seen as the return you get on an equity, and this is calculated by regressing the stock returns of a company with the market returns on a particular stock exchange. For example, you can have the Bombay Stock Exchange as a standard, and the Sensex can be used, the returns on Sensex can be used to regress the returns on the stock returns of ACC, the example I have taken, Associated Cement Companies, and what you will get is a number called beta. This beta is used as a particular number, and our risk-free rate of return you can see from the Bloomberg or Reserve Bank of India website, the treasury returns or say the government bond returns for 1 year. And your cost of equity can be calculated as risk-free rate of return plus beta times RM minus RF, that is excess returns over market returns. So when you use this, or for example, you can also use the dividend discount model, where the dividend which the company gives in previous years, say last year's dividend multiplied by the growth rate, D01 plus G, we call it D1, and D1 upon the price of the stock plus what you call the growth rate. So whatever these formulas are available in the material which you have been provided by the institute, I have seen fairly succinctly explained most of these formulas. So you can actually look into this idea as CAPM as one of the key methods for calculating cost of equity for firms. If you look at the idea of cost of capital, you would realize that unless you have the cost available of funds with you, your exercise of managing your organization could be futile, because it gives you an idea as to which way your organization is going, and then use this cost of capital idea for understanding something called your capital, evaluating your criteria or capital budgeting decisions. Now linked to cost of capital, I will not go into capital budgeting right away. As you know, capital budgeting is a concept where you evaluate projects where you invest money, and you have of course seen the discounted criteria and non-discounted criteria, discounted criteria being payback period and accounting rate of return, non-discounted criteria being NPV, IRR and profitability index as available in your text. So cost of capital becomes an element. First you calculate the cost of capital, then you evaluate the cash flows, and then you take a decision by using these decision techniques. So this is first part of the story. The second part, as we get into this concept, is something called security analysis and portfolio management. When you look at security analysis and portfolio management, again it's a fairly extensive idea in terms of understanding, and for that you need to understand the concept of risk and return. Now here, when you say security analysis and portfolio management, you have to identify, as you are a student of a particular program which is partially legal and partially financial, and you provide the legal and secretarial help to a company in taking its decision. But you need to understand that when you look at security analysis and portfolio management as a subject, you need to think from the point of view of an individual investor. You can think from the point of view of a corporate investor. You can think from the point of view of Government of India, which could be an investor. The government often parks its funds in several securities, and often asks the banks to invest funds in its securities as well, and often regularly government evaluates what the returns are. I'm talking about the statutory liquidity ratio concept of the banks, where banks invest in these statutory securities of the government. So you need to be very careful that when you say security analysis and portfolio management, as to what is your purpose. The basic of security analysis and portfolio management is, the basis of it is the concept of risk and return. In fact, I'll say it is the opposite. First comes returns and second comes risk. What we say is that returns are something where we invest anything in any financial or real asset. If we get some cash flow back from that investment, whether it is a real investment or a cash flow kind of a investment, financial investment, in both ways, the idea is that how much did I make in a year? Remember, there are two aspects of it, the debate, the discussion which we are taking forward. One is security analysis, the second is called portfolio management. So, the first part is the concept of risk and return. Along with it, it's very also important for you that, a lot of people say that when people evaluate stocks of different companies, what methodologies do they use? I'll tell you that is a slightly different concept, where when I start looking at security analysis in broad terms, people say, how do I find out whether the price of a stock which is listed in a particular stock exchange is a valid number? Could it be more? Could it be less? Can I say that the stock of ICSI, the example I took in the past example in cost of capital, which is running at say around 700 rupees, for example, I've not seen the present value, the current price, say 700, should it be 700 or more than 700? One of the reasons why people do security analysis is because they invest heavily in stock markets. And there, they are very particularly interested as to whether, the investment is a right decision or a wrong decision, and the key element of that decision is the idea that the price which they are paying is a fair price for the stock. The same applies to bonds also. In India, we do not have a very active bond market, and after a lot of intervention by the Reserve Bank, we are trying to slowly build up the bond market. But in Western countries, majority of the funds which people have, which they invest in financial markets, goes into the bond markets rather than the equity markets. In India, majority of the financial investment actually enters something called an equity market. And this equity market, which we call security valuation, again, I should explain this to you, that when I say security valuation, it's called valuation of stocks, valuation of bonds, and valuation of derivative securities. Derivative securities is something I'll tell you in a short while. Bonds, of course, is easy to understand. I'll explain that to you also. And equity, the first part. So, before I move into the concept of risk and return, let me just discuss the concept of security analysis. Now, when I say security analysis, I said that the key point is, if the price of equity of ICSI is being shown in the stock market today is 700, is it likely to rise? Is it likely to fall? Is it a fair price? How do I calculate it? Now, please remember that there are several approaches of security valuation, especially equity valuation. One is called the book value method. That the accounting equation says that the sum of asset, a company basically raises assets through something called liabilities and owner equity. So, we say assets is equal to liabilities plus owner equity, and this gives us a simple equation called assets minus liabilities is equal to owner's equity. And this we use in calculating something called the equity value of a particular firm. So, when I say equity value of a particular firm, we use the available data in the books of accounts of the firm, which are the income statements and the balance sheet of a particular company, especially balance sheet, and of course the profits which the company generates in a particular year becomes a part of assets, part of it next year. So, the point is that if a company's books of accounts are seen closely, the first method is called book value method. So, if suppose the market price is 700, book value comes out to be 750, then it's a wonderful stock to buy. If suppose the book value is 650, the book value is 700 and the market value market value is 700 and the book value turns out to be 650, lower than that, then probably the market has overpriced this particular stock. So, book value is the first method. The second method, which a lot of accountants and finance managers use, is called the discounted cash flow approach, and it has two variants. One is called free cash flow to equity and free cash flow to firm. Rather than going to details of FCFE and FCFF, which is a slightly advanced concept, I simply go ahead and tell you the concept called free cash flow. Remember that free cash flow of a particular firm, as your student of finance, is equal to NOPAT minus net investment in operating capital. NOPAT being net operating profit after tax minus net investment in operating capital. For greater detail, you can look at any of the finance textbooks as to how you calculate free cash flows. But the key formula is NOPAT, NOPAT minus net investment in operating capital. And what we do is NOPAT is EBIT 1 minus T, and net investment in operating capital is investment in operating capital in previous year, which you can see from the books of accounts, minus what has been done this financial year. Once you get this number free cash flow, we identify a growth level in the free cash flow, and then we find out the free cash flow, what we call a horizon value. Say suppose for 5 years I use the growth number, and the horizon value is the present value of all the future cash flows. So suppose the growth number is used up to 5 years of forecast. Say the free cash flow is supposed to grow at 5% per annum, and that means the second free cash flow would become FCF1 multiplied by 1 plus G. The third will become FCF2 multiplied by again 1 plus G, and I continue it up to 5th year. And after the 5th year, I use something called a horizon value. Say the 6th value I can take a horizon value, or I can take the horizon value at 5th year itself, discounting all the future values, considering the company is a perpetual entity. So free cash flows are calculated. Once you have the free cash flows in hand, you discount them to their present value, and then you identify the value of the firm, which is often the value of operations, which we call, which is called value of operations is the value of free cash flows, present value of free cash flows, and we say value of the firm is equal to value of free cash flows, that is value of operations, plus value of financial assets. If you can identify the value of overall value of the firm, subtract the liabilities, that is debt and what you call preference shares out of it, and what you get a number which can be divided to total number of stocks, and we can say that the equity price can be calculated in this particular manner. Now this methodology, which is very popular, a lot of material on web is available. Use the templates available with the textbooks which you are using as basic textbooks in this course, and you can use an Excel sheet, or also you can use a calculator to calculate the free cash flow sheet, and you can find out. This is the second method. The third method is called relative valuation for valuation of securities, and this basically utilizes something called the ratios which the firms use. For example, I use a particular ratio, price to earnings multiple, to find out the price of a share. So if I say that ICSI is a cement company, its stock is running at 700 rupees, which is the market price of the share. I select 10 other cement companies and I calculate their PE ratios, right? Their PE ratio, suppose the first company is JP Cement and its PE ratio I calculate as 10. I take another company, say Birla Cement, and its PE ratio is calculated as 15, and so on. I collect 5 companies and I take the average PE ratio. Now I multiply this PE ratio, which is price of share upon EPS, and multiply it by the EPS of ICSI this year. You will get a value which I call the equity value by using relative valuation method. This is the third method of evaluating the security price. Another interesting method is using real options. Now this is an advanced technique where you use the option methodology, and we call equity as a call option on the firm value. Once I discuss derivatives, you will understand it better, that equity is a call option on firm value. That means if there are 2 portions in a company, say equity and debt, the overall value of the firm is equal to equity plus debt, and we say that the value of equity can be defined as V minus D. Can we focus on the board for a while? Can we focus on the board for a while, and I can show the students this idea, which is a valuation approach for securities. And I say that now this method is a very simple method, and what we say here, that this is equal to something called a call option on the firm value, where this is the value of the firm. If you look at it, any call option is valued as a call option is actually valued as the difference between the spot price minus strike price, and we say that the value of the firm is the present value of all cash flows in the firm. Debt is the price of debt at the moment. Now what happens here? If debt is higher than the value of the firm, or value of the firm, in other words, lower than the debt, the firm will become bankrupt and will not pay anything to equity holders who are the owners of residue for the firm. If D is lower, then V minus D is positive and equity holders get some money in return. Now this method is used in conjunction with something called the Black-Scholes option pricing model, or any other template, any other formula which you use for calculating the call option value. Remember, use a call option formula, use the spot price. Instead of spot price, use the value of the firm, and in place of the strike price, use the debt. So debt is the strike price, and the call option value which we will calculate will become the equity value. Again, it can be used as a benchmark. So if you look at variety of models which we use today, we look at the idea whether a particular security which is trading in the market at a given price, the price in the market, if suppose it is higher than our calculated price, that means the security is overpriced. If the price in the market is lower than what we have calculated, if the price, remember I'll repeat myself once again, if the price of the security, say I said 700, our calculated value is 650, the security is overpriced. Our calculated value is 750 and the market price is 700, our security is underpriced. So people take the decisions of buying and selling, and this is often called a fundamental way of security analysis. How security is to be valued, this is the fundamental method of analysis of security. And of course, when you analyze securities fundamentally, you actually go ahead and look at all the possible ways apart from this. Although I've used the numerical methodologies first, but the key part is that you really identify whatever data is available with the company. This exercise is both valuation of securities is actually both science as well as an art. When I say science, it basically means that we use numbers to calculate and justify our decision. When we say an art, we try to identify as much information pertaining to this company and are capable of using that information, whatever is available at a given point of time, for valuation of this particular security. For example, if there's a news which comes suddenly that the government is going to invest heavily into infrastructure, the cement company's stocks will rise. If suppose on the other hand there is another use that the government of India does not have enough money to invest in infrastructure and there is no infrastructure growth, the prices may fall. So what you do is you do a lot of analysis, and this analysis could be the economic analysis which is related to the analysis of how the government functions, the fiscal policies of the government, the monetary policies of the government, the interest rate regime, the cost of capital levels, the inflation level, the demand level, all these things. The other thing could be at a company level. The company level analysis and fundamental analysis would be how this particular company is doing. For example, if suppose ACC suddenly it comes out in the news that ACC has huge negative free cash flow, this information will depress the price because people would assume that ACC will not be in a position to pay its debtors. And actually this is what has happened in real estate sector. If you look at the real estate sector, majority of the companies today have a negative free cash flow, and negative free cash flow actually means that the companies are not in a position to pay either dividends or returns to debt holders. If someone has given debt to the company, the amount of debt, the interest payments in case of debt is not possible by these companies. So when this information, a company level information comes, the stock prices fall, and you would realize that this is what happens in the market. Whenever a good news comes related to a company, the prices, say a company has got a new invention or an innovation, say Microsoft, or another company has, say Samsung has launched a new range of smartphones which is going to add to a lot of volumes to its sales. So the revenues are going to rise, and this would again lead to a higher security price. So security analysis requires a fundamental way of calculating prices. The other one is something called a technical analysis, which is largely based on a price volume information analysis. In price, again, this is a theoretical thing, I won't concentrate much on it, but again the problem with these two models is that they both depend on a particular theory called efficient market hypothesis. Now in technical analysis, largely what happens is that people identify the price data and the volume data associated with it and create charts. These charts help them identify as to when someone should buy a security and someone should sell a security. I'll add here that as you go through your topic on efficient market hypothesis, you would realize that markets are, either strong form efficient, or on the other extreme weak form efficient, or semi strong form efficient. Remember that a lot of people say that when the markets are weak form efficient, technical analysis work. Experts say these are conjectures people draw out of their researches, no conclusive evidence that always the markets follow the technical chartists. When the markets follow fundamental way more, they say that the semi strong form is applicable, and again there is no clear verdict as to the markets are semi strong form efficient all the time. The strong form efficiency, of course, is rarely to be seen. I must also define here what I mean by these semi strong form efficient markets, strong form efficient market, and weak form efficient markets. The weak form efficient markets basically believe that the security prices that I'll come from the strong form basically means that all available, whether private or public information, is reflected in the security prices, whereas the semi strong form says that publicly available information affects these stock prices. The weak form says that whatever the prices are, they are true. No amount of information can affect these prices right away. So if you look at each of these concepts of market efficiency, you would say that you actually link them with the markets and how the analysis of portfolios actually works. So if you look at, I'll once again repeat the definition. What we do is that there is something called a weak form efficiency, there's something called semi strong form efficiency and strong form efficiency. The weak form uses least amount of information and says that any amount of information that will pass price, volume, or other market statistics, they provide no information on the market, and if the prices are random, the past prices cannot be used to forecast your future prices. Similarly, the idea is here that if I say if again this can be understood that if you start using technical analysis with weak form and no information, then technical analysis won't actually work. Whereas in case of semi strong form analysis, technical analysis may work. Again, in semi strong form analysis, even fundamental analysis works a bit. So if you look at the idea of analysis, a lot of statistical tests are conducted on the data available, and this data ultimately gives you an idea as to whether a particular form of efficiency can be used. But apart from this, you need to understand that when I calculate the security prices are independent in every market. Say in US, for example, the markets are largely semi strong form efficient, whereas in India markets tend to be swayed largely by some very fairly random at times, but you cannot expect any particular time of efficiency to hold in markets which are not so broad and wide as in US, the case of United States. So when you link security analysis with the efficient market hypothesis, you must be very clear that while using your technical charts or the fundamental information, what form of efficiency a particular market actually follows. So when it comes to, again, let me move on to the other part of the story, the security analysis leading to our portfolio theory. Now in case of security analysis, when it works, your agenda is that I am trying to find out whether I need to invest in a particular stock or not. The second part is, if I combine this stock with several other stocks, whether they are fixed income stocks or stocks with what we call equity, you should be in a position to understand as to if I combine all of them, what should be the return. Now I come to the idea of the concept of risk and return. Remember, I'll give you a quick recap what I've done in security analysis. I've told you that security analysis is about valuation of securities, and valuation of securities is about valuation of stocks and valuation of bonds. Largely I've told you that there's something called valuation of stocks which is done by a lot of people through fundamental methods or technical methods. In fundamental methods we use the available information, say books of accounts, and available economic information about the company and the environment, economic environment the firm exists, company related information. Technical valuation is about looking at the prices, the way they are moving, and the what you call the volumes associated with the prices, and identifying whether the prices are moving up or down, and then deciding whether to buy the stocks or sell the stocks. Along with this, you use what you call efficient market hypothesis, and the efficient market hypothesis would be weak form, strong form, and semi-strong form. And these are divided in terms of the kind of information levels they are associated with. Say weak form, least amount of information; semi-strong form, publicly available information; and strong form, all public and private information. So when information is associated with security valuation, we become a little more scientific in our approach in valuation of securities. Of course, I should add here that there's something called valuation of fixed income securities, which is valuation of bonds. Valuation of bonds again is a simple concept. It is used often, and it's a more particularly exact method of valuation than the equity valuation, because in equity 5 different experts may give you a price of security and none of them could be correct. Whereas in bonds, everyone will come to a single conclusion. In case of bonds, what happens that there's something called a par value of bonds, and there's something called which is called a face value of the bond, and there's something called a coupon associated with the bond. Suppose I have purchased a bond which has a face value of 1000 rupees, for example, at 1000 rupees, and the bond promises me to pay a coupon of 10%. That would mean I'll get 100 rupees income, and the life of the bond is 10 years. So I'll receive 100 rupees each year of the bond, and at the end of 10 years I'll get something called 1000 rupees plus 100 rupees, that is next final years. So each year 100 rupees, and the final year now the price of the bond today will be equal to the present value of all these cash flows. So if I write this here, so if I have a coupon and it is discounted at something called required rate of return, we call it, and I C1 C2 upon 1 plus R whole square up to what you call C10 upon 1 plus R whole square plus the face value upon 1 plus R raised to power 10. Now this becomes the price of the bond, the present value. It's a very simple formula actually. It's the IRR of the cash flows associated with this stream of cash flows, and this becomes the price. Remember, the key point to understand is that in case of bonds, if the face value is, say, face value is equal to 1000 rupees, the coupon was 10%, which is equal to 100 rupees per annum. This means that I discounted this 100 rupees at a required rate of return, R. Right? Now you will find out that you can calculate this, you can calculate the value R, and this R will be compared with this. Actually what people do, we call this R yield on the bond, which is a very important number. If yield turns out to be higher than this coupon rate of 10%, say 12%, my bond price would be lower than 1000 rupees. If yield is again lower, my bond price would exceed. Remember, there's an inverse relationship between price of the bond and the value of the bond. So what I said in a short while ago, let me just recapitulate what I said in terms of valuation of securities, that there are certain concepts which you need to understand here. These concepts are that valuation of securities is, or security valuation as your course suggests, is about valuation of equity and is about valuation of bonds, which is fixed income security. equity valuation largely has two dimensions. One is called the fundamental, the second is called the technical. Bonds have a simple discounted cash flow approach. In fundamental approaches, I told you that we have something called market value, we have something called book value, we have something called the discounted cash flow approaches, and we have something called real option approaches, the option version which I told you, real option approaches. And and these approaches are linked with something called efficient market hypothesis, and this efficient market hypothesis works like this. So there's weak form here, semi-strong form here, and strong form here. And this is, as the circles become bigger, it's the availability of information, right? So what happens that often when this works, you cannot predict prices using technical analysis. The only way out is I do some kind of a fundamental analysis in the stock. Here this is semi-strong. Here I can do some technical analysis, some fundamental analysis, and largely speaking, most theories says that most markets in the world are semi-strong form. The strong form means that all public privately available information. Now this theory basically is tested by using whether people can indulge in insider trading in organizations or not, and most countries have insider trading laws, but still insider trading does happen, evidence suggests. In case of semi-strong form, people use several methodologies, say fundamental approaches or technical approaches. In weak form, the prices become very, very random, and under a random walk it becomes very difficult to predict prices by any method. Some fundamental cue can be taken or some technical cue can be taken here. So what happens here is that the approaches of security valuation are linked with something called a theory called efficient market hypothesis, which is seen in conjunction with information available about your equity and about your fixed income bonds, that is, or fixed income instruments available in the market. And now we come to the point as to what do we do from this information when we talk in terms of portfolios. Now this is again another interesting concept which is used as which has been used by several experts over a period of time in different ways. Now remember that when you say portfolio, a portfolio actually is a sum of securities. They could include something called different types of equity, or they could use plus fixed income security, or an individual can have in his portfolio real estate, or an individual can have gold in his portfolio, depending upon something called risk aversion. In most advanced countries, as I told you, people tend to invest in bonds more than equity, whereas in India, majority of the investment population, I would like to add here that in India, say barely 2% people, 2 to 3% people hold something called demat accounts, and these are the people who trade in financial security markets, and majority of them, say 85 to 90%, actually have equity. The other instruments are the derivative instruments. Now with the commodity products also available, we had people trading in spot and derivative exchanges. So what happens is that all these together make something called a portfolio, and understanding this becomes something called a portfolio management exercise. Now when I say portfolio management, again you must come, now we come to a point called so this is called risk return analysis in short. So when you say risk and when you say return, the risk idea is actually variability of returns, And the return idea, as I said initially, is the amount of money I make in an investment. So return, how do I define return? You know, there's something called holding period return, and this holding period return is nothing but identifying the amount of money. For example, I have invested in a stock and I invested 500 rupees in the stock. Now I also receive dividend to the rate of 25 rupees each year for next 5 years on the stock. So the stock at the end of 5 years becomes 1000 rupees. What is my return in this period? So my return will be calculated as something called the capital gains which I have received, right? Remember that the capital gains here are 500 rupees, and then you've received for 5 years 25 plus 25 plus 25 plus 25 plus 25, 125 rupees for 5 years, which is called the cash returns on that investment. Now this total divided by your capital gains plus returns divided by your initial investment become what you call. So you know, when you look at the concept of returns, how I work with returns is very simple, that I have to first identify where I'm investing, what is the series of returns I get. So you know, in other words, the total returns can be, this is the first concept is called holding period return, and this is so the ending price is 1000 rupees plus cash flows of 125 rupees, and the initial price of securities is 500 rupees, right? So what happens is that the beginning price, sorry, minus 1 will give you the answer. So the answer would be 1125 upon 500 minus 500. And what you make is called something called holding period return. So holding period return is a basic concept which is used in security analysis and portfolio management. And what people do is they calculate whatever securities they have got, they keep calculating its holding period return. And each holding period return is then associated with the correlation between these securities, and you end up calculating something called overall portfolio return and risk. Now I'll just once again, you know, tell you that when I say returns, this part is important, that you know, we have different types of returns, right? So you be careful as to what returns you use. You can use, you know, what you call arithmetic returns. You can use something called geometric returns, right, which are known as CAGR, right? So you can use, you know, and we have, of course, I have defined something called holding period returns. We can use something called internal rate of return or something called yield also, which takes into consideration time value of money. Remember, each one is different, so you need to be very careful as to how each one is linked. So when you use returns, the first part is how do I calculate the return on a portfolio. So whatever return I use, for example, if I use different returns and I have different securities P1, P2, P3 in my portfolio, and I call it, and P, for example, each I can, you know, I'll just tell you the exact format of it. I say I have P1, P2, P3, 3 securities in my portfolio, and I have the weight of each of the portfolio known to me. So each of the portfolio, or I say that each of the weight I define, say Pi into Ri, I is equal to 1 to n, where P is the weight of individual securities. So the way we calculate the portfolio return is that individual weights of securities, say I have 100 rupees in my pocket, I invest 25 rupees in one security, 35 rupees in another security, and 40 rupees in another security. So you know that the weights are 25, 35 and 40%, These are multiplied by the returns on each one of them, right? And each becomes, the total becomes something called my overall weighted average return. So the return of an individual security can be seen in different dimensions, but when it comes to a portfolio, it becomes a weighted average return on the portfolio. Now, when there is an individual security, let us come to the concept of risk. Now, when you have an individual security, its returns can be many. Say for example, if I calculate a return series in 1 year for the stock called ACC, and I say that I've got January to December data, say January to December data for 2015 year, that is 2015, and I got data, say this is called month end return. On every 31st I take the price of ACC security, I write the price here, and the price, say for example 700, 750, 800, 760, 850. So what you can do is use these two values to calculate a return in this period. This is return, this is price. So each period you can find out a return. This is 750 upon 700, 750 minus 700 upon 700, the first return, and so on and so forth. What you get, a return series. So someone can ask you, is this a good stock to invest in? So you will answer them that first I'll find, say for example, there are two ways. One is that I can find out a CAGR, which is the initial final value upon initial value minus 1, say raised to power 12 minus 1, and I can tell you that this is the return, CAGR return, for example, of the stock. For example, this is not the exact calculation. Now if I know the return, is it enough? If the stock is highly volatile, the return numbers will vary in each month. This volatility is called risk. So risk will become, if you have a series of returns and it gives a standard deviation number also along with it, we'll call, suppose the standard deviation is 6%. So now we are in a better position to look at this particular stock, individual stock, whether it's a good idea. If another company has similar returns, but its standard deviation is 8%, what will happen is that you will say this is a riskier stock and this is less risky. So risk normally is calculated by using a term called standard deviation. Risk is a term, and for example, for case of risk, the statistical number we use is called sigma. It is also used often in its squared format, which is called variance. This is called standard deviation, it's called variance, right? So for individual securities, when you look at the idea of risk, it is nothing but variation in return series over a period of 1 year. Now how do I go to a portfolio and calculate its value of risk? Now this is what is called a Markovics model. Suppose I got 10 cement stocks and I've got annual data in terms of return and risk levels of all these 10 stocks. How do I find out something called the overall return and risk of the portfolio? Say I had 1 crore of rupees and these have been divided across these 10 companies, and I want to now calculate after 1 year what is the standard deviation and return on my portfolio. So return on the portfolio, I told you, was very simple. It was weight, that is invested in each of the security or stock. multiplied by the return on the stock, and what you get is something called a return on the portfolio. How do we calculate the standard deviation of the portfolio? So this is called a Markovics approach, and this is where you need to understand it has several variants. The Markovics approach largely looks at, it contains three things. One is the individual standard deviations, the second is correlation between securities, right, and of course the weights, right. So if I say that if you have a security portfolio, so if we work on a kind of a series of say 10 securities, we will need to create a table now where we identify one, and we identify each of these 10 securities, and we identify how much money has been invested in each of these securities, and we have to identify. Now this is a typical problem. So once you start looking into the idea of getting into standard deviation of the portfolios, you need to be careful that this will become a tedious exercise if there are 10 securities. Now this is a problem which was first addressed as part of something called a Markovics model, and the Markovics model actually means that we start working on something called portfolio and the correlation of stocks between the securities. So here there's another term which we start using, we call it covariance, right. So instead of 10 securities, let me just start explaining it from a 2 security framework, right. And if I say 2 securities framework, that would mean that I'll have returns on 2 securities, say security A and security B. I have its return data, return on A, return on B. I have amount of funds invested in A, amount of funds invested in B, and I've got correlation between correlation A, B as data available with me, right. I also should have the sigma A, standard deviation number, and standard deviation number B. So in brief, actually this is explained as so what I have written is sigma I is equal to 1 to n, j is equal to 1 to n, wi, wj, sigma ij. Now what does this really mean? Now this Markovics model is a model where we start looking into a kind of creating a scenario where we have to calculate the portfolio variance. And this portfolio variance, as I said, I wrote it as where sigma ij is equal to sigma I, sigma j, rho ij, where rho is the correlation coefficient between them. Now remember, I is the rho format, j, and often we write it as wi, sigma ij for ease for the students. You can actually create a matrix for weights. So you could write your weights W1, W2. I hope you are conversant with matrix algebra. And here we write W1, W2. Say this is sigma 11, sigma 12, sigma 21, sigma 22. If you are able to write this, we call this Markovics model. So if you say, if you look at it, you know, here I'll explain once again. What is written out here is that the information which is required to calculate the portfolio variance, remember that what we will calculate as a result of this would be portfolio variance sigma square. The square root of this variance will become sigma, which is called standard deviation of the portfolio. This is a very important number. Now this has huge impact. This had huge impact on how portfolios were looked at, because I can expand this particular model to n number of securities. The only thing which will happen, that I'll have I is equal to 1 to n as weights, W1, W2, W3, W4, W5 up to n. I'll have n number of securities in common, W1, W2, W3, W4 up to n, and I'll have this n cross n matrix which is available at center. So with Excel sheets available, people can actually calculate it much faster and better, and a lot of models are available on internet. You can find out such models as to how Markovics model actually runs. For your basic purpose, a 2 security portfolio is a good idea. So now in the center is written as sigma 1 1 rho, and this, if I expand this now, just see this, it will become sigma 1 rho 1 1, it will become sigma 1 sigma 2 rho 1 2. An explanation is available in your textbook as well. Sigma 2 sigma 1 rho 2 1 and sigma 2 sigma 2 rho 2 2. So if I expand it again, sigma 1 into sigma 1 is sigma square 1, and rho 1 1 is of course 1. A correlation of first security with first security is 1, correlation of second with second is 1. So these two, this diagonal becomes sigma 1 square, this becomes sigma 2 square. In the Markovics terms, you know, this is the variance, the diagonal terms are variance terms, and these are the covariance terms. And again here also just see, rho 1 2 and rho 2 1 will be equal, right? So this will be the covariance term. So the calculations actually minimize in a particular n cross n matrix. The diagonal will always be, say, n terms across the diagonals would be the variance terms, and the remaining terms. So in a 2 cross 2 matrix, we have 2 diagonal terms, and remaining 2 are the covariance terms. So this is like both are actually same, sigma 2 sigma 1 sigma 1 sigma 2 rho 2. So you know, as you go and keep, what I request you is just try practicing this particular concept and writing the Markovics model in this particular format, and you will understand what I am saying in a much clearer fashion. Just put in the data, and what you will be able to do is just solve this matrix. What you will get out of this is that the end result, if you solve it, will become W1 square sigma 1 square plus W2 square sigma 2 square plus 2 W1 W2 rho 1 2, right? There are two terms of, this is 2 W1 W2. If I multiply this matrix and open it up, I am not doing it here, you can do it. Remember that you can always, in matrix, remember this is a 1 row 2 columns kind of a matrix which can be multiplied to a 2 cross 2 matrix, you are aware of it, and this is 2 rows and 1 column kind of a matrix, right? So what will happen is, when you multiply this with this and then finally multiply this with this, you will get a result, a standard result, and this is a statistical standard result. We call it and this is called the risk of the portfolio. Sorry, risk, not risk, I will call it variance of the portfolio. To calculate risk, I will take the square root of it, and then I will call it risk of the portfolio. So you know, this is an important result in security analysis, what we call Markovics model. And once you are aware of this particular model, you can, your life becomes much easier. Remember that if suppose someone says, make a portfolio for me, how do I make a portfolio using, so the information which is required is the amount of money which is invested in a portfolio across the board, which is, say I said 1 crore rupees to be invested, number of securities, the amount of money which has been invested in each security. So what you can do is you can calculate the risk of the portfolio and the return of the portfolio, and your decision becomes much easier. What really happens in this is that we utilize this in portfolio theory for calculating a frontier of efficient portfolios. What do I mean by that? A frontier of efficient portfolios is a combination of securities. Say starting from, if I keep changing the weights, what will happen? If I fix a return, I can get a series of different risks. If I fix a risk, I can get a series of returns, and I can actually see what proportion of weights. So what really is done is that I fix a return and then identify what is the proportion of securities as they get distributed across. Often computer-based models are used for it, and for each level of risk and return, we get a frontier of efficient portfolios. So for each level of risk, we are able to create, say at this risk level, return. I'll just make it a slightly different one. So what happens is that this kind of a graph is often seen, which can be created, that as you keep changing your risk levels, your return levels for each of the risk level, and the weights allocated to the securities will also change. I fix a risk and identify what is the proportion of securities which are required to be in this portfolio, and this is one portfolio, this is the second, this is the third, and so on, right? And of course people actually link it with something called capital allocation line, and they call it RF here. And when you use Markovics model, you calculate your variances from historical data, right? And using, you can use the share returns and returns, past returns, and you can get a very fair idea as to what is the, and this is kind of often it's a population kind of a study where you can be in a position to calculate as to what my portfolio's risk would be, and what people get is something called a capital allocation line where RF is the risk-free rate. So as I get into details of this, let me just give you a recap of what I said till now. Remember that we started the session with an idea of cost of capital, which I consider as a very important concept because it is used in a large number of places in finance, and this is where our security analysis is also linked with cost of capital, and I use the term WACC here, weighted average cost of capital, and here I said WACC is defined as weight of debt, right, and something called cost of debt, which I can write as cost of debt 1 minus T plus weight in equity into cost of equity, where E is the cost of equity, D is the cost of debt, WD is weight in debt, WE is cost of equity. So first important concept, and the key point here is, how do I find out the cost of debt available in your material? How do I find out the cost of equity, again available in your material? And I said the cost of equity, when we calculate, several methods which are used to calculate it. One of the popular methods I said, in security valuation also I'll connect it with it is that the fundamental approaches for valuation of securities are the ones which are also used here. So this was the first, this is cost of equity. I'll tell you the popular models for calculating cost of equity. There is a dividend growth model, this is called Gordon's model, or Gordon's model, dividend growth model, which is used. There is something called the CAPM model, which is the next topic, of course, in our security analysis also. In the CAPM model, actually what we say is that the return on equity, and you will see how cost of capital is again linked to valuation of securities. This is equal to risk-free rate of return plus beta times RM minus RF. I referred to it a short while ago in some other context also. So what happens is that you've got the return on equity as risk-free rate of return, and this return of equity is what is called cost of equity. Right? This is the first important concept, and this is used everywhere for whether you need your decision criteria and capital budgeting, whether you are talking about, again it is related to capital structure, but again capital structures are largely linked to what people say, that in order to reduce cost of capital, I would like to have a particular cost of say a particular capital structure, so much of debt, so much of equity. Equity, remember, is always a costlier option than debt, and often equity holders pay a price for the debt holders. So what we have is that if you look at the first concept was this, the second concept was valuation of securities, right? And I use that why? Because I said that your topic is called security analysis and portfolio management, right? In security analysis, I of course said there is fundamental approach, there is technical approach, and there is something called efficient market hypothesis, which governs both the approaches, because we are talking about informationally efficient markets. Remember, efficiency has several meanings. I am adding here. Efficiency could be informational, could be transactional, could be locational. We are not talking in terms of transactional or locational efficiency here. We are actually talking only in terms of efficiency in terms of information. So we take a break right now, and we come back after 10 minutes. Thank you. So welcome back to the session on financial treasury and forex management, FTFM. We had discussed the idea of Markovics model prior to the break. The Markovics model actually is a very good model to calculate the variance of a portfolio. Similarly, there are several other models, and these two models, we will discuss two other models in this context. One is called the single index model, which is part of Markovics model, but uses a slightly different technique for calculating the variance of the security. And what happens is that if you look at the single index model, which is used often, we have nothing much of a difference. Remember that what we do in calculating our single index model is we take value from the Markovics model. The Markovics model gives us the idea of variance. So what happens is that if you want to calculate the returns of a security at time t, then these returns largely are a function of something called the excess return plus beta times returns on the market, right, plus. Now this is a simple model where what we do is that we are trying to actually understand as to how a particular stock at time t and its return is based. Remember that there is not much difference between the models which we use on single index terms. There are two variants of it. One is where we calculate our standard deviation from historical data using Markovics from historical data, and the second is where we use the standard deviation from this regression model. Remember that when you are talking about the standard deviation from regression models, what really happens is that if you have done regression analysis gives you an idea that a sample is selected. Remember, in historical standard deviation, the entire historical data has been used. Suppose I have taken 5-year data for calculating standard deviation, and that I have used as part of the Markovics model. Now, this single index model is a very simple kind of a model where I use, say, last 1 year data, and from there I calculate the variance using this particular returns and variance using this. So the return estimate is this. This is the market return, this is the stock return, right? And this becomes the excess return, and this is the standard error of the regression model. Here the standard deviation or variance of the stock is basically a function of two numbers. One is called variance of the market and beta of the stock, which we calculate through the regression, and of course the sigma square of the error terms, which is called standard error term, right? You can use any of the methods, but remember that when I use the Markovics model to calculate variance, I took a series of data and straight away calculated its variance by taking, say, the entire series of numbers, took the square root of this, which is called of sigma square, which is equal to sigma, standard deviation. So there is a minor difference between these two approaches, and these two approaches actually give us an idea as to how different the return series would be. Remember that in a basic single index model, the returns are not the entire returns on the stock's history. It's not the entire population. We take a sample of stock returns and we regress them with the market returns. In return, we get the number beta, right? I can use this beta with standard deviation of the market, and then I take standard error of the error terms, and this together gives me something called sigma square of the security, right? Sigma square of the security, and the standard deviation of it becomes the risk on the security. So the key difference to be noted is that the single index model is a regression equation based model where we assume that return on a stock at time t is a function of market returns. The returns could be excess, which is seen as in the equation alpha. So in a single index model, remember that I must reiterate that the Markovics model is a model where we calculate variance of a stock, and using the variance of the stock we can actually create a frontier of efficient portfolio at different variance or risk level. The square root of variance is risk. At different risk levels there are different returns, and there you can identify, I created something called a frontier of efficient portfolios, and we could find out as to how much should be the composition of the portfolio at each of the points. Remember this? I made a graph like this. At each point of risk, this is return on y-axis and this is risk on x-axis. So the basic purpose of our Markovics model was to give us an idea as to what should be the standard deviation or risk level, right? And at each risk level we were able to create a standard return level. The other model which we discussed is a single index model. Why do we call a single index model? Because it assumes that the stock returns are affected only by one factor, which is called the market or the stock market on which the stock is trading. This is opposed to something called multi-factor models, and the multi-factor models are known as in finance arbitrage pricing theory. In arbitrage pricing theory, we assume that the stock returns are affected not by one but many different factors. Now remember that, and a variant of this is called a CAPM. Now what is CAPM? CAPM has two different ways of looking at it. What CAPM says, that the stock returns again are a function of and often this alpha is known as a risk-free rate of return. Right? So a capital asset pricing model is essentially again a regression equation which replaces alpha with RF and this market return with excess return. How does CAPM actually work? You again select a sample data, say last daily closing return of a particular stock are listed here. Say you've got 252 returns here. Market works 5 days a week, approximately 250 days a year. You've got daily closing returns. So you get daily closing price and then daily closing returns. Remember, this is daily closing price and this is daily closing returns, which is the difference of two prices divided by original price. Say day 2 minus day 1 upon day 1 price will become the return. Now if you have these returns of the stocks, you put them in a series here. This is a series. Similarly, see the market returns. Say market returns daily, market prices daily of the stock price index, and this is index price and this is index returns. Remember, index price and index return, if there are 2 days, day 2 and day 1, index return is equal to P2 minus P1 upon P1 into 100 and you get a percentage return, index return. In more exact terms, when you do financial research, you actually do log P2 upon P1, right? A geometric return can be calculated that way. So what are we going to do with this data? We are going to use it in a regression equation and we are going to take a result which is called a CAPM model, right? Again, like as any regression equation, the CAPM model will give you an idea as to what the regression based sigma square would be, which will be different from what our single factor model was, right? So when you look into the concepts of the models, we have several different models which are available, right? And the models which we use often in terms of what we call single index model or other risk models, the only difference is how we calculate the basic number called standard deviation, and they give us an idea as to, now in this case of CAPM, we use something called a security. Remember, in case of a Markovics model, the term I used was called capital allocation line, right? Here we use a capital market line or a security market line. The equation which we used for a single stock was that if I make a frontier of efficient portfolio, it starts from here. This is the risk-free rate of return, this is return, and this is risk, right? And my equation is that this line has a slope beta, this line has a slope beta, right? And I call for a stock, this is called SML, right? Security market line. So what we do is that as we go ahead and work on the concepts, you should be in a position to understand that under security analysis and portfolio management, these models which came, they differ in terms of how they calculate the returns, and therefore the standard deviation terms which come along with it, and then that becomes a decisive number for calculating a final portfolio value. Remember, the key to it is that if you can calculate a particular standard deviation in a particular number, then you will be able to calculate what you call a portfolio return and portfolio standard deviation. Right? So the entire story, in one case we used historical data, in the other case we used a base regression result, in third this regression of the stock with market, right, a basic single index model, and then we had a regression where we regressed stock with excess returns, right. So this became our CAPM, and this became a basic single index model, right. So this gives you an idea. Once you get the return, you get the standard deviation. So if there are 10 securities in your portfolios, for each one of them you repeat, and then you get 10 different, of course, numbers, what you call sigma 1 to sigma 10, and you get return 1 to return 10, and the way you utilize them, your portfolio's return will be equal to weight into returns for sigma I is equal to 1 to 10, and your portfolio standard deviation again would be equal to sigma I Wi sigma ij wj, weight and covariance. So if you have 10 securities in your portfolio, you will also create a correlation matrix between the stocks. So 10 stocks, take the data for say 1 year, 2 year, 5 years, whatever it is, collect the stock prices, collect the returns, and between the returns calculate, so you can find out what is the correlation between stock 1 and stock 2, stock 1 and 3, stock 1 and 4, 3, 4, 1, 5, 1, 6, 1, 7, 1, 8, so 2, 3, 2, 5, 2, 3, 2, 2, 6, 2, 7, 2, 8, 2, 9, 3, 4, 3, 5, 3, 6. So your correlation coefficients will be there, right. So once you have the data on correlation coefficient, you are in a position to create a portfolio, by which I mean you can tell an investor that this is going to be your return and this is going to be your risk on the portfolio. The models differ only in terms of the way they calculate returns. In a historical return model, the entire history of returns is used. In what you call a single index model, stock returns are regressed with market returns. In a CAPM model, stock returns are regressed with excess of market return over risk-free rate of return. Remember, the idea is you also have a series of RF in CAPM, not just market returns, stock returns, but also risk-free rate of return available in the market at a given point of time. So now we move on to the remaining two topics. The other one which I wish to discuss with you is something called derivatives, and the final one would be something called foreign exchange management. Now, as a matter of fact, if you work on the concepts, I have some questions with me from the participants, which I'll last half an hour would be utilized for the question answer sessions. Now, when I work on the agenda of working with a particular concept, we have a particular contract which has come into the market, and this contract is called a derivative contract, right. So when I say a derivative contract, what is a derivative which needs to be added here? Now, the topics which we are going to discuss now, remember that we've discussed cost of capital, security analysis, portfolio management, are derivatives and forex. Let me give you an overview. Remember that both of them are connected somewhere, because in forex also there is something called currency derivatives, which are very popular now, and the trading in currency derivatives is more than what happens in derivatives in stocks or commodities. Now let me just discuss first some of the points as part of your course, the basic concepts of derivatives, the participants, and the derivative markets which are there, and each one of them would be discussed in brief, but you are requested to shoot your questions to me, and then I'll try to give as many answers as much clarify the concepts as much as possible. So if you look at the idea of derivatives, derivative is a contract. Right? And it is defined as per the Contracts Act. It's a contract between two parties, right? Party 1, which is called buyer, and party 2, which is called a seller. The buyer is called long, the seller is called short, right? Then why do we call it derivative? In stocks also there is a long and a short position. In derivatives also there is a long and a short position. The only difference is that here you are taking a position in the market without investing your full money. What you're doing in a derivative market, you are buying an asset, but you are not buying it by paying money. You are simply promising to buy and take a delivery some point of time later. The exchange, if the contract is traded on the exchange will have a clearing house which will stand guarantee to the transaction. But any derivative contract can also be over the counter. So we've got two types of contracts largely. One is called an OTC contract. The second is called an exchange traded contract, right? So I'll write it a little more clearly for your this thing. So a derivative contract will have something called OTC and exchange traded. So OTC contracts are contracts between two parties enforceable only in a court of law. If one party reneges on the promise, says it will not honor the promise, then there is only one option, that you go ahead and sue him in a court of law. Whereas exchange traded contracts have exchanges backing them. Now what do we trade in OTC? The most popular contract on OTC is forward forex contracts. Today we've got forward forex contracts in the format of forwards, futures, options, and swaps. Sorry, not futures. We have forward contracts, but futures are only exchange traded format. Forward, options, and swaps. Exchange traded, futures, options, right? There's another category which is developing slowly, that's called swaptions, which is called option trading on swaps. I'll write it here. It's called a swaption, right? This is an innovation again on the existing market. So in OTC format, banks basically give you forward contracts which are buying or selling a foreign currency at a particular time in future, and these values are calculated based on the premium or discount on currency. Options, on the other hand, are positions taken by banks, or they are in the forms of what you call calls and puts. So calls and puts. Calls basically means that someone buys an option, someone buys a forward, for say if someone buys foreign currency for a particular date, but he does not buy in full, he pays a premium and buys a call option contract. A put option means that he will sell a particular amount of currency and he'll charge a premium or pay a premium, say in a put option contract, and sell that currency in future, option contract. Swaps are again of two types, currency and interest rate. Let me just first discuss in detail the OTC idea using Forex, then I move on to something called exchange traded contracts. For this, you can actually consult your study material along with John Hull's book, Options, Futures, Swaps and Other Derivatives, right? John C. Hull, 7th edition, available in market. The basic concept of an OTC derivative contract, I said there is something called a forward. Remember that futures are nothing but exchange traded forward. There is something called an option, and there is something called a swap, one by one. The forward market, the forward contract is the simplest one. You can buy something forward and you can sell something forward. In our case, suppose we buy dollars forward or we sell dollars forward. Who are these people who buy or sell dollar forwards? These are, for example, say an exporter who has received, who is bound to receive, say in 3 months' time, say $100,000, right? So he will have $100,000 with him available and he wishes to sell them now to a bank. So the bank will tell him a rate which is applicable 3 months from now, right, on the dollars. And here, for the exporter, it will be selling of dollar. Remember, for the bank, it will be buying of dollars forward. The bank will buy dollars forward, the exporter will sell dollar forwards. An importer, on the other hand, has imported some machinery and he needs to pay for this machinery 3 months from now when it will arrive, and he has to send the money. So he will need to buy dollars forward, right, and the bank will sell dollars forward. So remember that every contract, like in any place, has a long and a short. So in our case, the exporter has shorted dollars forward, but the bank has gone long on dollars forward in case of an exporter. So be very clear, long means buy, short means sell, right? One party buys, the other party sells. So in case of forward forex contracts, these are called forward exchange contracts, and these are as per the norms of RBI's Foreign Exchange Management Act 2000, revised versions are available, right? So what happens, this is the only example actually I can give you of forward contracts. They are not available on exchange traded format. The exchange traded version of forward is called a futures contract. We'll come to that later. So you have something called a forward contract. Now here what happens, an importer is in the need of buying currency forward, so he goes and takes a long position. An exporter has a need for selling currency forward, he goes and takes a short position forward. So we have something called forward contract, and what will happen, say today is 19th of May, and you enter into a contract for 19th of July or say 19th of August, say 3 months from now. On that day, you will go to the banker, you will say that this amount, I am an exporter, I have received $100,000 in my account, please credit. You gave me a contract 3 months back, say 19th of May, this was the price, 65.6746 kind of price per dollar, and it will be multiplied and put into your account minus plus the charges which the bank takes on it. So what happens in a forward contract is a very simple idea. You buy or sell anything, and the bank, it is between you and the bank. If the bank does not fulfill its promise, you have no other option but to go to court. The other example in the OTC format, which is very similar to what we have in exchange traded also, is an option contract. They are of two types. One is called a European and the other is called an American. Say a European option, and both are call, put, call, put. What is the difference between European and American? The European option can be exercised only at the time of its expiry. How does an option actually work? An option is defined as a right but not an obligation to buy any asset from the other party. So if I have purchased a call option, I have a right to buy a particular asset from another party which has sold me this option. I'll pay a premium to him, right? The word used is option premium. By paying a premium, I can buy a call option or a put option, either European or American. In case of European, I'll exercise my option only at the end of the time period, could be 1 month, 3 months, whatever is mutually decided between us. And in case of American, I can exercise it anytime. American options therefore are riskier for the seller, so he charges higher premium. The premium for American options is always higher than a European option. So what really happens is that in any option contract, the key part is actually they are very simple to execute, and that's why people like it. The only technical thing about options is the pricing. There are two broad ways the premiums are calculated in case of options. One is called a binomial methodology, the other is called a Black-Scholes options pricing methodology, right? Both these techniques give you an idea as to what the price would be. Approximation, both of them give you a clear idea as to they are very close, and people use them as a basic price to buy or sell options. And these could be on anything, like largely we are talking about OTC, so options on OTC, largely again we have currency options, foreign currency options. So these are available with banks on different currencies, and they can be bought by paying a price. Now the third concept is swaps. This again is very well defined in your books. These are of two types. One is called an interest rate swap. The other is called a currency swap. Now what are these? Remember, a swap again is nothing but a series of forward contracts between two parties. What happens in a swap actually is, I'll tell you first of all why people use these swaps. People use these swaps for several purposes. First of all, say interest rate swap. Parties use interest rate swap to reduce interest cost, to change nature of liabilities. What do I mean by nature of liabilities? Nature of liability, the loans available in the market are on fixed rate or floating rate. So what parties do, if someone has a fixed rate liability, it want to convert it into floating rate liability, or a floating rate liability into a fixed rate liability. So someone takes a floating rate loan and converts it into a fixed rate loan by using a swap deal, one way. But again, largely people do it for reducing the interest cost. For reducing the interest cost, what they use is something called a comparative advantage arguments. The comparative advantage argument is like this. Say there are two parties which have A and B, which have fixed rate loan and floating rate loans available to them, both. The fixed rate loan is available to party A at 8%, party B at 10%. The floating rate loan is available at MIBOR, which is Mumbai Interbank Offer Rate, plus 8.5%. MIBOR plus 85 basis points, right? And for party B, MIBOR plus 170 basis points, right? So you see here that both parties have some difference, and this is because of their credit worthiness. Party B has lower credit rating probably, that's why the interest rates offered to this party for loans for a given amount are higher. Suppose we are talking about a loan for rupees 10 crores, or let's increase the value, rupees 1000 crores, right? Now, how does the comparative advantage argument work? A swap dealer would come and find out whether a swap is possible between these two parties, right? And he'll say that the difference in the fixed rate market, say A, is 2%, that is 10% minus 8%, and between this is B, which is 85 basis point, MIBOR plus 170 minus MIBOR plus 85. A minus B is 200 basis point, 2% is equal to 200 basis points, 85 is equal to 115 basis points. The swap dealer would come to a conclusion that yes, now a swap can be created between these two parties by ensuring that a benefit of 115 basis points can be transferred between these two parties. You can look into the textbooks for details of forming the swap deals, but largely what happens is that when we use swap as a basis, we often end up lowering, in this case what will happen, the party which had say 8%, 10%, let me write once again, MIBOR plus 85, MIBOR plus 170. This is fixed, this is floating, party A, party B, right? So you see that, comparatively, party A has, advantage in both the markets. It is getting lower loans in both the markets, but its advantage is very high of 2% here as compared to only 85 basis points here. So the swap dealer would ensure that party A borrows at fixed, party B borrows at floating, right? And then based on the benefits which are accruing between them of 115 basis points are shared between them. So if you look at the idea of fixed and floating rate markets, almost every company today faces this trouble of borrowing at a very high floating rate, but they tend to convert that into a fixed rate by using these swap deals. It's not very difficult actually. The swap dealer decides as to this is the amount to be paid to me, and party A say borrows from the market at 8% and a fixed price. We can do the calculations also, but again for the positive time not doing that, but the swap actually looks like this. So there's a party A which will borrow at 8%, party B which will borrow at MIBOR plus 170 basis point, and through a swap dealer, the payments will, what we need to calculate is these payments. The swap dealer will make a calculation based on whatever benefit party A tends to get. Remember that the benefits also can be calculated very easily. So if you have a 115 basis point and party A has taken a floating rate loan, what will happen? The net liability of final liability can be converted to a floating liability through this, and for this it can be converted to a fixed liability, right? So two things will happen. both their interest costs will fall and the floating and fixed rates. So from fixed it will go to floating, from floating it will go to fixed. Now in a similar manner, there is a currency swap which is often a very big market. Forex derivatives are the biggest market, and these swaps are actually the largest component in that market as well. World's biggest market, forex derivative, swap markets the biggest market among them. So what happens in a currency swap is that, say there is a company A in India and there is company B in USA. Company B in USA wishes to set up its business in India, and company A wishes to set up its business in USA. In a currency swap, company A takes a loan in rupees and passes on to the subsidiary of the US company here. Company B in USA takes a loan in dollars and passes on. We call this facility as a parallel loan. So currency swaps again are of various types. Again, a comparative advantage principle is worked out as to what is the rate on rupee paid by Indian company, what is the rate paid by the American company on dollars, and what is the comparative difference between these two countries. So this again is affected by the swap dealers, which are often banks, and the rules are, you can actually find out a lot material on International Swap Dealers Association's website in this game. So this was our OTC contract. There's something called an exchange traded contract now. Now exchange traded contracts, forwards are only over the counter. Their counterpart here is called a futures contract. The other is called options contract. These are the most popular exchange traded contracts, the future and the futures contract and the options contract. Remember, first of all, let me tell you the difference between futures and forwards. Futures are exchange traded, forwards are over the counter. Futures contracts basically are mark to market on a daily basis. Now this is another term which you need to understand. Mark to market basically means that once you enter into the market with a particular price, the price will change in the market. Once you enter into the market, you deposit some earnest money, right, with the exchange. Now this money is called your margin or initial margin. The exchange, using risk management techniques, they use the SPAN system, Standard Portfolio Analysis of Risk, which is nothing but a variance of a process in statistics called Garch models, and it tells you what the volatility of the market would be based on previous day's volatility. So they identify initial margin using those Garch models, right, and the SPAN system, and they tell you something called maintenance margins. So you've deposited, say your initial margin deposited is 1000 and your maintenance margin is 2000. So in forward markets, what happens, there is nothing called a margin. You just go and do a deal with the banker in forward contracts case, and at the end of the 3 months you go and pay the money. Nowadays actually we don't really look at much on the full payments, but we largely look at those forward contracts where only differential amount is paid to the buyers or sellers, whatever the value on that day is. So initial margins are paid on a daily basis. Suppose you have taken a long position, you can also take a short position. You've bought something at something like, say, 700 rupees, right? Now taking a long position, if the price rises, goes up, then whatever gets added to your account, say price rises at the end of the day by 200 rupees, your margin gets added by 200 rupees, right? If it the price, if it goes to 900, your margin account gets added. If it falls, your margin account gets depleted by 200 minus 200, 800 rupees, right? So, you've deposited initial margin and your margins have been given, and suppose in case of a long position, in a short position this margin would be different. In a long position, suppose I have gone, the margin suppose is kept here. I have taken a short position and I have just changed it, just take a note at it. I have gone here to 500. So the exchange won't say anything if you lose. But if you lose below this and 100 more and the price falls to 400 and your loss is 100 more, this would reduce to 400. Your value minus 200, as the price keeps, it becomes 800. Some more loss, as say first day minus 200, so your price is 500. Next day again I say 200. So as price falls and your margin and the price suppose goes to 200, you've lost 500 rupees and your margin reaches 500. Any further loss, you will be expected to replenish the entire margin by 600 rupees. You will get a margin call. For this, for more understanding of mark to market, please look at Nick Leeson's, Google this term. Nick Leeson's trades on Singapore exchange, where he lost a lot of money because he didn't answer the margin call and he led to the collapse of Barings Bank. Look at the Barings Bank case study for further understanding of this. So what happens is that as my maintenance margin falls below, suppose it goes to 400 because I've lost 600 rupees on this, say 700, the price goes to 100, I've lost 600 rupees where I took a long position. So it becomes 400, I'll have to replenish 600 rupees to make my margin up to 1000. Now this is an interesting concept, and it happens, that if you take a position in forward contracts, you will be mark to market only once in the contract's lifetime. That means at the end of the contract. Whereas in futures, there is something called daily MTM position. This is an interesting term because it has other financial connotation. We've got FAS 157 of the US accounting standards, which defines the fair value assessment, where MTM is used heavily. So you need to understand that now, with the international accounting practices being applicable in India, understanding MTM in accounting terms is equally important, right? So once you start getting into this game, you realize that your contracts will be mark to market on daily basis. So it's not an easy thing. I took a long position, the prices fell, I have to pay my money from my pocket. If I take a long position, prices rise, what will happen? You will keep getting money added to your account, right? So what happens in case of a currency futures contract or any futures contract, that your losses and gains are calculated on a daily basis till the contract matures. The contracts are available on exchanges in wide variety. So you have futures contract on currency, you have on interest rates, now you have on stocks, individual stocks, and the first ones in India to enter this market were stock index futures, right? You have now currency. Apart from that, there is another side, commodity futures, huge market. If you are aware, the FMC has been recently merged with SEBI. The regulator was Forwards Market Commission under Ministry of Agriculture, Department of Consumer Affairs. It has now come to what you call SEBI under Ministry of Finance. So please go to the website of Ministry of Finance and check up SEBI and FMC on commodity futures data. It's a huge market by itself. So in futures, one part is that they are available on wide variety, they are mark to market on a daily basis, and the fact is that they are easily tradable. You only pay a small entry amount called initial margin or some maintenance margin to enter and trade into the market. So these are all derivative contracts in a way which are exchange traded are highly leveraged products. You pay a small amount and you take a position. You can take as big a position as possible. So they are, of course, they come up to a point where they have an impact on the exchange. So the exchanges need to have a very strong surveillance as well as clearing and settlement system. in these markets. So therefore they work on this futures contract. So the futures contract, the pricing part of it, that's also very important. It's called the cost of carry formula, and we calculate it always as, you know, the futures or forward price of an asset is equal to the spot price of the asset into right. So the forward price of an asset is in simplest possible term is this is the cost of carry, right. So what we have is that often, you know, in exact terms, S0 e to power, say what you call what you earn minus what you pay, right. So what we have, like in case of foreign currency futures, it is written as, so what we do is that the spot price is compounded at a particular rate R. In case of, for example, a forward currency futures, say rupee dollar futures, we call it S0 e to power R minus RF. The forward rate of dollar, right, say spot rate of dollar, forward rate of foreign currency dollar, spot rate foreign currency, that is dollar, R Indian interest rate, RF foreign interest rate, and this is actually known as interest rate parity theory also. In other terms, in simplest terms, you can write it as, you know, F0 upon S0 is equal to 1 plus domestic interest rate upon 1 plus foreign interest rate, right. It's actually, I can write it as here, right. This relationship is called interest rate parity theorem, and this is used to value what you call forward exchange contracts as well as futures contract. So this has to be kept in mind. Similarly, the other contract is the option contract. So I have told you option in OTC, option in exchange contracts are the same, except that your premium calculations in an exchange traded contract, what happens, it is the premium which trades on the exchange. So you've got series of options, say calls and puts, and their strike price. In options, actually, you must understand that there are some key terms. There is an you know, apart from the call, put, American, European, you've got option, you know, to be seen as a particular contract whose price needs to be calculated on certain basic terms. In futures, the calculation of price is very easy. In case of options, the calculation of price is slightly typical. How do we do it? You know, you have to find out several matrices. You've got to find out the time to expiration of the contract. You have to find out the risk-free rate in an economy. You've got to find out the dividend yields which are available, you know, on the particular stock. You need to find out the volatility of the stock, right? So you need to find out the spot price of the asset, right? So what happens is that the interest rate and the interest rates prevailing in the economy, say, what happens is that when you look at the calculation of forward premium on the options, I would be really looking at several aspects, not one, and the Black-Scholes option. These premiums are quoted on the exchanges, and people normally convey, and often, you know, the prices of this, say for example, a call option premium is S0 minus K e to power minus RT, where Ks is the spot price and K is the strike price. So, you know, what is given on the exchange, you can go to any of the exchanges today. For example, we've got the Bombay Stock Exchange, the Stock Exchange Mumbai, known as BSE. You've got NSE, on which all the contracts are available. You've got MCX, on which commodity options are contract, MCX SX, and you can go to these major exchanges. You also can go to the SEBI website for information on these contracts, how they are governed, which gives you an idea. So in case of the put option will be the opposite of it. These values, often the call and put option values, are calculated by using Black-Scholes and binomial option pricing theory, and that is the only technical thing about them. Remember that options can be used in multiple terms, and options, you must also understand that they are part of, when the payoff profiles and option trading strategies are very popularly available. You can draw them as, this is a call option, this is what is called a long call, this is called a long put, this is long call, short call, a long put, short put. What people do as traders, they combine these positions in several formats, and they identify their profits based on how they are combined. Depending upon, there's something called a strike price. This is the strike price at given levels. So whatever the strike price is given, I should draw it like this. K, and I should draw it like this. K, right? The strike price. This is the spot price x-axis, and this is the payoff of the option contracts. So nothing much in these contracts, except that in futures the calculation of pricing is very easy, and in options the pricing is a little difficult. As far as clearing and settlements are concerned, the trading, clearing and settlement of these contracts is in the similar manner as you trade and clear stocks. You've got National Securities Clearing Corporation for the NSE, and you've got other clearing houses which are created. There's CCIL, which helps for the trading of government securities. But yes, in case of derivative contracts, you go to NSE website and see, or Google NSCCL. The clearing houses actually become the basic linchpin in the system. They are the ones who stand guarantee to any of the trade. If a party does not take a position, then the clearing house is there to support them. So clearing and exchanges is basically theoretical. Let me come to the last topic, paucity of time, which is called forex management. Now in forex, some key points which I can tell you in case of forex. This is about foreign currencies, right? Today in India, if you go to Reserve Bank of India website, open Reserve Bank of India website today itself, look at how at 11 o'clock RBI gives you reference rates of 4 currencies. You will find a dollar reference rate, you will find a Japanese yen reference rate, you will find, say, a British pound reference rate, which is called GBP, and you will find a euro reference rate. This is a far cry from 1993. In 1993 we got something called liberalized exchange rate mechanism system, and after that rupee became fully convertible on trading account, right? Remember, this is also important to note that rupee is still not fully convertible in capital account, although the conditions today are such that we have fair amount of freedom for people to remit money, say up to $250,000 abroad each year, and you can get freely money from outside into India. On remittances there is control, but you are fairly free. So we are moving towards a direction of something called capital account convertibility. But what we are fully convertible on is called a trading account, right? So you don't need a permission, but of course there's an exchange control form when you make your trade documentation, which is to be used for filling up the details of the transaction. But yes, you don't need permission to export, import, or if you have the right reason, nobody stops you from doing transaction, buying and selling of these currencies. The Reserve Bank of India today gives, there's another change. We are using today something called a direct quote. I also got a question from someone where someone says direct quote written as indirect quote in the same exchange, then ask bid should be constructed as bid ask. Yes, in direct quotes, in foreign exchange, what we say, there's a unit foreign currency and a variable home currency. So today if I say 66.4845 is the price of dollar, this is the price of $1. So this is called a direct quote. Prior to this, prior to 1993, we were saying rupees 100 is equal to a given number of dollars, where local currency was taken as unit and home currency was taken as variable. So direct versus indirect quote, remember in any market, the bid and ask is seen as something called buy and sell. Like as I said, long and short, long, short, buy, sell, bid, ask. They are always in increasing order. So if you buy something at 40 and you sell something at 42, right, they are in increasing order. So people, why does it happen like that? You always gain when you buy low and sell high, and everybody quotes the prices in a similar manner. You buy everything low and sell them high, right? So if I invert the quotes from direct to indirect, of course the ask bid also would be opposite. So the rule is always buy low, whatever be the quote, and sell high, right? So work out an argument where buy low and sell high works out, and of course because your direct versus indirect quotes are opposite, that will also change. So in foreign currency, we've got, say, two important things. One is the quotation of spot rates. There is called spot quotations and there is something called forward quotations. Forward quotations are two types: fixed date forward and option forward, right? Spot quotations are in a sense the basis of any calculation. In these markets there is something called cash, say, term, spot and forward in ascending order, but the basis of the market is the spot market. What happens? Spot market tells you how the prices of a particular currency are pitched today. Say for example, I said 66.4645 or 4648 is the rate of the foreign currency called dollar. So this is the spot rate quoted. That means if I undertake a transaction, this will be applicable 2 days from now. If I want today's rate, then the bank will give me a different rate, which will be derived out of this spot rate. If I need the currency tomorrow, then again a slightly different rate, and of course the rates will be quoted on a bid ask format. Remember, a bid ask is from the point of view of the bank. Bid ask, I'll write bid ask. Say for example, if bid ask is written as 66.4648 and 4670, right, there's a gap of 22 paise. For example, it's fairly high, but I can write it like that. Say 22 paise. So I'm saying that I am a banker, I'll buy from you at 66.4648, but I'll sell to you at 66.4670. So even if today you come to me in the morning and I buy dollars from you and you come back to me after some time and you want me to sell the dollar back to you, I'll charge those 22 paise extra. Are you getting it? So this is actually a part of transaction cost and is known as, these 22 paises are known as bid ask spread, right? So spot quotations are quotations which are applicable 2 days from now, and if you want to do a calculation for today's rate or tomorrow's rate, you have to do some adjustment to it depending upon whether it's the bank may sell you even higher rate today, slightly lower tomorrow than the spot rate. Say if today's rate I have to find out, it will be lesser than, the bank will buy from me even at a lower rate than this today if the spot rate has been quoted 66.48. Banks always have their own commissions and the charges which apply, and they add to it. So when they buy from you, your price would be depressed even further because they'll charge commission from you. If they sell to you, they'll charge commission from you and the price will move up. So that is one part of the story. The other part is now the forward rates. The forward rates are calculated as I said a short while ago, as the forward rate of a foreign currency is the spot rate raised to power r minus rf, or in case I can say that the forward rate is equal to s into 1 plus domestic interest rate r upon foreign interest rate rf. So what you do is you look at the Bloomberg website or Reserve Bank of India website and Federal Reserve's website in US, check up the interest rate on similar securities, say treasury securities, say 90-day securities, India, 90-day security India, or a 1-year security there, 1-year security here. Use those interest rates, put them here. So if you want to find out 1-year interest rate, use 1-year interest rates. If you want to find out 3-month interest rates, use 3-month interest rates. Remember that interest rates are always given per annum. You have to use the period associated with it. Say 90-day interest rates per annum will be used here. And then if you have the spot rate available with you, multiply this with this ratio of interest rates and you will find out the forward rate. You will find something very interesting, that if the US interest rates are lower than Indian interest rates, the forward price of dollar will go up, just see, and it will be at a premium, or vice versa. So this is the forward versus spot relationship, and of course they have fixed options, fixed date options and forward options. The banks quote them, if you tell them a fixed date, they'll use their calculation in a similar manner. If they use option rates, use in another manner. So I end my session on Forex with this. We are short of time. I have tried to cover 3-4 topics today, and maybe we can do it some more when time permits, because you have exams. So I wish you all the best for your exams.
So we have some more queries regarding Forex. So this is one of them. What is Forex trading? What is floating charges? So we can explain this if we have time.
Yeah. So I'll first take the first part, the first initial idea. Some of the questions which have been asked to me are, what is the difference between horizontal capital structure and pyramid shaped capital structure? So a horizontal capital structure is the one where there's zero debt on a company's books, whereas in a vertical there's a small equity base and then you have debt above it, whereas an inverted pyramid capital structure is what you call, you've got small equity, retained earnings, and above that huge amount of debt. So horizontal versus pyramid, the answer is this. The other question was the concept of financial distress. Financial distress is something when the value of the firm becomes lower than the value of debt which it carries. Say Kingfisher Airlines, for example. The company went into financial distress because value, as I explained in a particular segment of my lecture a little early, was that value is nothing. Value of a firm is equal to value of operations plus value of financial assets, and value of operations is equal to free cash flows, the present value of free cash flows which are embedded into a firm. What happened with Kingfisher Airlines, they didn't realize that when they opened up this idea, the price of oil was moving upwards, which is very different from today, when the price of oil in the global market 30 to 40 is hovering between 30 to 50 dollars per barrel. In those days, between 2004 onwards, in upward movement, the price actually went up by 2008 to $140 a barrel. That led to increase in operational cost of the airline. An airline uses one of the major components of airlines, and that too, along with rupee depreciation, a bit of depreciation between 2003 to 8. There were a double whammy on this company, and the value of operations started going down. So as the value of operations, which the company revenues went down, what really happened? The debt amount and the debt servicing for the company became very difficult. A point came where it was impossible for them. They tried restructuring of debt, but it didn't happen. But in theoretical terms, what I say is that when your value of operations are lower than value of debt, your equity value becomes negative, and you feel something, what we say, that a company has suffered something called a financial distress. Today, financial distress is also defined from the bank side in terms of non-performing assets. there are loss assets, above that are doubtful assets. They first start with non-performing assets, NPAs they call it. If a particular loan or an installment or a interest is not paid in 90 days, the bank calls it a non-performing asset, and slowly, so it becomes NPA later. It starts with something like, a doubtful asset to a loss asset in a series. So, distress basically means that a company is getting into some kind of a position where it is unable to service its debt. How capital structure work? Third question. Capital structure, as I said, is again dependent upon the requirement of a company. They decide what should be the debt or equity. There is something called a Modigliani-Miller hypothesis, right? It says that capital structure does not matter. But largely, remember, Modigliani-Miller hypothesis works in a very organized kind of a world where, everything is predefined, there are no taxes, no friction. But yes, what happens in a capital structure is that, there are two types of companies. One which is called unlevered company, and the other which is called a levered company. An unlevered company is a company which takes no debt, and a levered company is something which takes debt. What happens when a company takes debt? When a company takes debt, it has to pay a fixed contractual amount to debt holders, right? So that means that if a company has first zero debt and now 50% of the company's capital is now debt, the equity holder has to pay from his pocket to the debt holder. Earlier the entire money was going to the equity holder, the earnings. Now a part of it goes to the debt holder and goes out of. What happens is that the income, and why do companies take debt? Because debt is always tax deductible. So the whole idea of capital structure is that how do I define my debt and equity holdings so that I take advantage of debt, but yes, it also causes a little more uncertainty on the firm. If you look at it, the concept of leverages, if you start taking debt, your leverages actually change. And again, it is dependent on the kind of industry you are. If you have higher fixed cost kind of a sector, there are two types of companies, one with more of variable cost and the other with more of fixed cost. So depending upon them, if you do an EBIT EPS analysis kind of a thing, you will find out that your capital structure affects your overall earnings and the existence of the firm itself. I've already answered the question on direct quote, indirect quote. What is capital structure? I said it is debt equity structure of the company. The concept of cost of capital is like weighted average cost of capital, which I explained earlier. Weighted average cost of capital is how much debt you take, how much equity you take, to calculate the weight and multiply the weights with the interest rates or the cost you pay, and you have something called a cost of capital. Forex trading. Now, foreign exchange markets are largely among banks. They are the market makers. 85 to 90% markets are among banks and central banks. Remaining is between the importers, exporters, travelers, people who remit money into India or remit money outside India, and so on. Forex trading basically is not done through exchanges except Forex derivatives. Currency derivatives, that means currency futures and options, you can go to the BSE and NSE website or MCXSX website, which trade in Forex. Whereas Forex derivatives, currency options and futures. Forex, in terms of currency, is traded in computers, and this market is active 24 hours. On a computer, different banks and their traders take positions. In India, day trading is not allowed. With other countries, day trading where it is allowed, people take positions on currencies. What happens that you can give bid and ask rates on the computer for given amounts, right? And depending upon the quotes, the other party accepts it, and using an international settlement system, the trades are settled. So what is the actual meaning of algorithmic trading? Algorithmic trading is nothing but a software trading in place of human beings. What people do is that they read the markets, feed the data into computers, and create a software, a code, which takes a buy or sell position. Remember that nowadays the way trading takes place is that it's like, in a particular exchange, the orders are arranged in a particular order, in a particular, 5 best buys and 5 best sells are given on a particular exchange's screen at any given point of time when the trades are getting settled. Now, when we trade personally, we look at the prices and we click the buttons of buy and we give the orders, buy or sell. But when the computers do it, they do it much quicker than us. Today in global markets, international exchanges, almost 80% of trading is algorithmic trading, and some estimates say that majority of trading now in India is also algorithmic trading. Now this is very difficult to catch. There's no proof as such where you can find out the trades which were taken or the orders which were placed were by computers. There's no specific idea. But yes, majority of the people now trust computers for placing orders than human beings. Flotation costs are, the other question is flotation cost. This is when you float a security, whether equity or debt. You are to incur cost which is paid to the merchant banker and other costs. For example, when Government of India had to raise money for its PSUs, they went on a road show. So if you send people of the company along with government officers on a road show to US, that would be part of flotation cost. If I hire a merchant banker, then there will be flotation cost. Then why holder has unlimited profits but limited losses, but writer has unlimited profits but unlimited losses? This again is a very simple idea. What people do is that when there is a call option, remember that it all depends which position you take. If you have taken a call option, you bought a call option, you have limited profits, you have unlimited profits. I'll draw it through a diagram here. So what you have in case of derivatives, remember if you've bought a call option, you have limited loss, unlimited profit. Whereas the writer has a mirror image of yours. He has same K, limited profit, unlimited loss, right? So a short has this is a short call, and this is the writer of an option. So writer of an option is the one, he's called in a short position, and this is a long call. This is called holder or buyer of the position, right? So the buyer has unlimited profits, he has unlimited losses. Opposite happens similarly in, this is a put option. The buyer will have limited profit, unlimited losses. Whereas, this is the short, again I'm wrong, this is the short. Here the seller, again in put option, the seller, the one who writes will have unlimited, you see this, unlimited losses, gains. What is the gain? It is the premium he earns. So buyer of a put option, limited loss, unlimited gain. So each of these situation, what you can do is, for clarity, I'll make all the 4 diagrams once again. So just look at it. I made this for the call option. I made this for the put option. Both these are long positions, holders of options, right? Unlimited profit, limited, and these are the opposite. So it's a 2-person zero-sum game. This guy's profit is this guy's loss, and this guy's profit is this guy's loss, right? The other question is, briefly explain Modigliani-Miller approach. Now it says that in ideal circumstances, capital structure does not matter. The Modigliani-Miller hypothesis is a simple term. In ideal conditions, capital structure does not matter. They show you through different examples as to how EBIT or leverages actually work, but largely the statement is capital structure does not matter. What is capital account convertibility? It's about bringing funds into an economy for very long term. You need to take permissions, and that is called capital account convertibility. Current account is trading, and capital account is long term funds. When you bring funds from abroad, for example, I want to issue a GDR today as a software company, which is a global depository receipt. I'll have to go through required permissions to issue this GDR, or I want to take some, get into something called foreign currency convertible bonds. So I'll have to seek permission from relevant authorities. So that is called capital account convertibility and nothing much. So capital account convertibility is for long-term purposes. The day when for long-term purposes you won't have to seek any permission from the authorities, say RBI, which controls it under FEMA. For more detailed discussion on capital account convertibility, do download FEMA, which is available, BEAR Act, available on RBI website. So what will happen is that capital account convertibility is a simple idea. For long-term purposes, I need permissions. Once it is over, capital account convertibility comes into
security analysis, derivatives and forex management, and also answering to the queries of the students. Students will surely benefit from this session. ICSI always comes up with new initiatives for students. Live webcast is an example of that. In addition to this, the institute has also come up with practice manuals on cost and management accounting, company accounts and auditing practices, advanced tax laws and practice, financial treasury and forex management. Soft copies of these practice manuals are uploaded on the ICSI website under the head Academic Corner. The students who wish to procure the printed copies may purchase from the sale counter of ICSI regional offices, chapter offices, or order it online through e-cart on our website. For guidance related to June 2016 examination, you can visit Academic Corner of our website. Now, one thing I want to remind you all, today we have another webcast on the subject Economic and Commercial Laws Executive Program, starting from 2 p.m. to 5 p.m. So please stay tuned, and those interested may kindly attend the webcast and ask their queries. In the end, I would like to thank you all for watching us and asking your queries, and we wish you all the very best for your examination. Thank you.
Thank you.